Hello and welcome. Today, we're going to tackle a topic that, let's be honest, can feel pretty overwhelming: tax deductions. But here's the plan. Instead of getting lost in a bunch of rules, we're going to approach this like a top consultant would, by breaking it all down into a really clear, logical system. The goal here is to give you a framework to understand not just what deductions are, but how you can actually make them work for you. And it all starts with this one kind of weird question. How can spending money actually save you money on your taxes? It feels a little counterintuitive, right? Well, that's the core puzzle we're going to solve together today. And by the end of this, I promise you'll see deductions not as some chore on a tax form, but as a really powerful financial tool. So, to get there, we're going to use a simple four-part agenda. First, we'll cover the what, the basic concept. Then we'll get into the how, the actual mechanics. After that, we'll look at the who, seeing how this works in the real world. And we'll wrap it all up with the so what, which is really all about what this means for your decisions. It's a logical breakdown designed to take you from maybe a little confused to totally confident. Okay, let's jump right into section one, the what. Before we can talk about any kind of strategy, we have to get on the same page with the most fundamental building block of all. What is a tax deduction anyway? So here it is. A tax-deductible expense is just something you can subtract from your adjusted gross income, or AGI. You can basically think of AGI as all the money you made in a year, minus a few specific things. But here is the absolute key takeaway. Deductions don't lower your tax bill directly. Nope. What they do is shrink the amount of your income that the government can tax in the first place. And of course, a smaller taxable income means a smaller tax bill. So why does the government even do this? Well, deductions aren't random. They have a purpose. The government actually uses them as a tool to incentivize behaviors that it thinks are good for the country. Things like donating to charity, buying a home, saving for retirement, or even starting a business. You can almost think of the tax code as giving you a little nudge in certain directions. And that brings us perfectly to section 2, the how. So now that we know what a deduction is and why it exists, let's get into the mechanics. How do you actually claim one? Well, every taxpayer basically comes to a fork in the road and has to choose one of two paths. Path number 1 is the standard deduction. It's a simple, fixed dollar amount that anyone can take. It's easy, no questions asked, no shoebox full of receipts. Path number 2 is to itemize. This is where you add up all of your specific individual expenses. It's definitely more work, but for some people, it can lead to a much bigger deduction. So which path do most people actually take? You might be surprised. Since the tax laws changed back in 2017, which made the standard deduction way bigger, the vast majority of taxpayers, we're talking about 90%, now take the easy route. For most people, the standard deduction is just a bigger number now. And here are those numbers for the 2024 tax year. So if you're a single filer, you get a $14,600 deduction right off the bat. If you're married and filing together, that number jumps to $29,200. These are the magic numbers, the benchmarks you'll use to make your choice. Which brings us to the big question. When should you bother itemizing? Honestly, it's just simple math. You should only go through all the trouble of itemizing if your list of eligible expenses, we're talking things like mortgage interest, big charitable gifts, state taxes, if all that stuff adds up to more than the standard deduction for you. If it doesn't, just take the standard deduction. It's the better deal. Now, before we move on, we have to clear something up because this confuses everybody. A deduction is not the same thing as a tax credit, not even close. Like we said, a deduction lowers your taxable income. A tax credit is way, way more powerful. It reduces your final tax bill, dollar for dollar. So a $1,000 credit saves you $1,000 in tax. A $1,000 deduction only saves you a percentage of that, depending on your tax bracket. You gotta remember, credits are king. Okay, let's move on to section 3, the who. Time to make this a little less theoretical. Let's get practical and look at who's using these deductions and what they're using them for. So for that 10% of people who do itemize, what are they claiming? Well, it's usually these big ticket items. Things like mortgage interest on your home, state and local taxes, though there's a cap on that now, big donations to charity, or really high medical bills. These are the kinds of expenses that can actually push you over that standard deduction amount. But there's another deduction out there that's incredibly powerful and it's available to a lot of people, whether they itemize or not. I like to call it the retirement super deduction. Here's how it works. When you put money into a traditional retirement account, like a 401k at work or a traditional IRA, that money often comes right off your income for tax purposes. Look at the example. Say you earn $50,000 and you smartly contribute $5,000 to your IRA. Boom, that $5,000 comes right off the top. So as far as the IRS is concerned, you only made $45,000 this year. I mean, think about how cool that is. You're literally getting a tax break today for doing the right thing and saving for your future. Now, when we talk about businesses, it's a completely different ballgame. They don't get a standard deduction. For a business, the whole point is to deduct all the normal necessary costs of just being open. Things like paying their employees, paying rent, keeping the lights on. They subtract all those expenses from the money they bring in to find out what their actual taxable profit is. All right, that brings us to our final section, Section 4, the so what. We've covered the what, the how, and the who. So let's zoom out, look at the big picture, and most importantly, figure out what this all means for you. When you look at the system as a whole, tax deductions are, well, they're a mixed bag. On the one hand, they do encourage good things and can help make the system fairer for someone with, say, huge medical bills. But there are real downsides. They make the tax code incredibly complex. They can mess with the economy. I mean, just think about how the mortgage deduction impacts the housing market. And often, they tend to benefit higher income folks the most, since they're the ones with the big expenses needed to itemize. It's a tricky balancing act for sure. And all of this, everything we've talked about, it all boils down to one single decision you have to make for yourself every single year. Do you take the simple path with the standard deduction, or does it make more sense for you to do the work and itemize? And here it is. Your decision comes down to this simple 4-step framework. Step 1, add up all your potential itemized deductions for the year. Step 2, look up the standard deduction for your filing status. Step 3, compare the two numbers. And step 4, just pick whichever one is bigger. That's it. That's the whole game right there. So, I'll leave you with this final question to think about. Now that you have this framework, this new way of thinking about deductions, how are you going to look at your expenses differently from now on? Because you don't just have a tax strategy now, you have a brand new lens to look at the financial choices you make all year long.